I remember last year, the best performing sector largely was, one of them was energy, at least outside of oil.
Yeah.
So oil didn't actually go anywhere. But if you look at a lot of the equities, they were some of the best performing space. So your asset managers have been selling down and taking profits on a number of those as well. And the entire sort of zeitgeist, if you will, with respect to energy has changed. But if we look at the fundamentals, they're still very, very favorable. I'm reminded of the quote from George Soros, which was that, what did he say? He said, find the premise that is false and bet against it. And I believe that the premise that there's sufficient energy, I believe that to be false.
Hello and welcome to Capital Cosmo, everybody. Today we have a very special guest that I've been looking forward to interviewing. It is none other than Mr. Chris MacIntosh. Chris, thank you for coming on the show.
It's my pleasure. It is my pleasure. Happy to be here.
Awesome. Before we get started, though, nothing in this video is financial advice. We're not financial advisors, so please do your own due diligence. With that said, Chris, give us a little background in terms of who you are, what got you into investing, and tell us about capitalist exploits as well.
Just further to your comment with respect to financial advice and all of that sort of stuff, I do need to mention that we have an asset management company which is SEC registered, and as such, please do your own due diligence, consult whoever you need to, talk to your dog, talk to your neighbor, whatever it is that you need. But so that is out of the way. Okay, where do we start? Back to how did we get here? So let me start with where we're at today, and then I'll dial back just a little bit and try and keep it fairly brief. So we run an asset management company called Glenorchy Capital, which began as family and friends investing along with myself and my business partner, Brad McFadden, which then turned into us writing letters, or myself mostly, predominantly, writing letters or notes to clients on a sometimes weekly, generally it was sort of kind of a weekly basis. And they seemed to like that. That started getting shared around. One thing led to another. Being a capitalist at heart, I decided that was quite a good avenue in order to actually build another revenue stream. And hence Insider was born, which is really just us talking about the kinds of things that we're looking at in the world, our investments, what sectors we're invested in, and so forth. So it's broadened from what it used to be, which was more dedicated to the client portfolio, as a consequence of us having clientele from varying, at least within the subscription service, everything from students, university students that are looking to try and educate themselves about worldly matters, investments, things of that nature, all the way through to billion-dollar hedge fund managers that are looking for different ideas. And so, we've attempted to, and I think done a fairly decent job of accommodating everything in, across that spectrum. So that's pretty much where we're at today. I began life as a investment banker, and didn't do that for that long before I realized that I was not really cut out for the corporate world, and moved into becoming an entrepreneur, looking for opportunities that led me into real estate, where I built a real estate investment and trading firm, which got to where were we? September of 2006, whereby things started looking a bit hairy, and I cannibalized and sold everything, liquidated everything within about 4 months of that business. And that was just ahead of that good old GFC, which it wasn't like I necessarily saw that coming. But sometimes you can take advantage of the other side of the coin. And the other side of the coin was quite simple. There wasn't sufficient value in almost anything except for cash. And so cash is what I went to. And of course, that was the trade. Subsequent to that, I then saw opportunity in where I thought the next bubble was going to be, which was in venture capital. And so I built a venture capital firm, which I sold out of in late 2016. And I was about 2 years too early for that. So that entire market now is imploding, as most people would probably be aware. And that was when we started Glenorchy and everything else we talked about now. So that's kind of a brief history, if you will, of how I've got to where I've got to now.
Yeah, so I alluded to at the very beginning of this show that you were one of the guests that I was most looking forward to interviewing. And the reason behind that is you were actually the first person to turn me to the commodities trade. And we cover commodities across the board here on this channel. And I remember one specific interview you had with George Gammon. This was back in 2020. And you had mentioned uranium. And I had never, that uranium wasn't even on my radar screen. So you mentioned coal, uranium, all these different commodities. I got turned on to your newsletter from there. I've been a member, for about 3 years now. So I highly recommend your newsletter to my viewers. It's really good. So I continue to learn, every single, weekly post that you put on there, as well as your webinars and stuff. But I really want to dig into how did you evaluate opportunities like this? How were you one of the first people to, really get into the commodities trade? I think you've been in uranium since 2017 or 18 or something like that. And you've been in the commodities trade for quite a while. How were you able to identify these opportunities?
Right. Great question. And let me preface it with this. We have, it's often not necessarily that you can tell a fantastic trade is coming or is setting up. It's sometimes a matter of relative value. So there's two things: relative value, and the other one is that timing is not my forte necessarily. I've just pointed out that I was too early on real estate, about a year too early. I was too early on venture capital, 2 years too early. But what's that old saying from Willy Waggle Dagger? Better a moment too late than a week too late than a moment too early, or something like that description. So, we're not timers, we're not traders, but what we attempt to do is to build a diversified portfolio of high convexity trades. And we do that predominantly through sectors. So what we'll often look at there's two angles to it. One is just deep value investing. You'll look for deep value. You'll look for what doesn't make sense in terms of valuations, cash flows, all of the normal sort of metrics that one would look for as a value investor. And what we're more focused on, as I mentioned before, is sectors, not particular equities. If I was to give you an analogy, it's this in real estate, which most people can understand. If you were to walk down a street and find the dirtiest, yuckiest house in the best street, you might be able to buy it, tart it up, give it a lick of paint, mow the lawns, and get a profit on selling it, right? That's not our interest, because that requires us to do hard work. I'd rather be lazy. So what's more interesting to me is to find an entire neighborhood that for some reason is undervalued. That could come about as a consequence of a new highway network that is being put in with an off-ramp that now feeds to that neighborhood. Or it could be a university that's being built, or it could be any number of different almost exogenous factors that can influence the valuations in that neighborhood. That's interesting to me because I can now be extraordinarily diversified. I can be lazy. I can go and buy every house in the street. And so that if you take the previous example, I might buy that shitty house, give it a lick of paint, mow the lawn, and then I find out there's a plumbing problem or an ant problem or like any other. So there's a lot of things that can go wrong. That's when you're buying an individual company. An individual company can have any number of things go wrong. The CEO could run off with the CFO's wife. You could have fraud. You could just talk about uranium. Cameco had a mine flood, right? These things can happen, and they can significantly affect your returns through something that you didn't identify. When you buy entire sectors, you can diversify across the sector, but you still want the same convexity. And so we look for sectors that have that type of convexity, and then we will deploy into them. We'll almost always deploy too early, but then we wait our particular investments until we start, like we'll see uranium as a good example. A lot of the numbers made sense to us. A lot of the fundamentals made sense to us. So we took a small position in it. And then we waited and we waited. And as that started moving, then we just changed our weighting slightly. And that's a really good example because, that was probably our worst trade insofar as timing. So we bought into that and we had to wait nearly 4 years. And over a 4-year time frame, we literally made no money, zero. And then over about 18 months, we were up anywhere from 5 to 8 times. Okay, because you're buying at such extraordinary lows, it doesn't take much to move that needle. And we could be diversified across the sector. So you could say, okay, well, what's an 8 times return over a 4-year time frame? It's a pretty decent return. We're happy with that, but it's not linear. Now, if you build yourself a portfolio with a whole lot of positions like that, that gives you an ability to be diversified across sectors that provide for convexity, while also not taking extraordinary risk. Because when you take something like uranium or coal or a number of these things that we got into very, very low, you could go down maybe 20, 50%. But if you've got a 5-10% weighting on a 50% on a trade that moves 50%, it's not going to hurt you. It's not going to particularly hurt you. You'll still be able to sleep at night. But if your convexity is such that that can go up 5-10 times, that's a good trade. That's a trade you place. And where people get caught up on is where they go, oh, but I don't know if it's bottomed yet, Chris. It might not be, like, I think it's still going to go down more. Maybe, sure, but maybe you're wrong. And so that's essentially our thinking as to how we go about things, and uranium simply fitted into that particular metric. But one other element I want to come to it. So there's the deep value side of things where you're looking for these high convexity trades purely on metrics, things such as valuations and all. The other element, and I think is becoming or has become more prevalent and will become even more important as we move through the decade, is geopolitics. And so there's not just a matter of finding out what sectors one should be invested in, but it's also very important to be understanding of the politics, right? So, for example, you're not going to go and buy a coal mining company in Germany where they've eliminated all their coal. Yet coal has been one of the highest convexity trades that we've had. And then we continue to believe it will continue to do so for probably the decade. So it's not just a matter of going, oh, well, coal's good, and I happen to be a German and I happen to live in Germany. Let me find some companies to invest in the space. No, you need to understand the what's going on in the world and where capital is moving to on a geographical and an international basis. That's extraordinarily important in these times. So where those two factors collide or coincide is where we get comfortable with building positions, if that makes sense.
Right. And that's actually one thing that I really enjoy about your work, Chris, is because you actually don't view investing in a vacuum. You understand that there's geopolitics that interact with our investments, and it's all capital flows. It's money rotates to where it's treated best. And right now, money, from what I'm seeing, money is flowing from the west to the east. Now, it's not going to be a transition where you just flip the switch and all of a sudden, you've got a bipolar world or what have you. But where do you think we are currently in this transition cycle, whether it be a de-dollarization? Are we still in the very early stages? How long do these transitions of power, of capital, of these capital flows typically take?
Yeah, look, I guess we always look we look to history to try and give us some sort of understanding of what's most likely to transpire ahead of time. We're certainly well into the phase of this shift. And I mean, you could go back and say, well, it actually began 20, 30 years ago in terms of movement of the industrial base from the West, okay, whereby the only thing that was kept was R&D. I mean, that's kind of what the dynamic was. So saying, well, okay, if you're Apple or something like that, you'd say, well, let's move our industrial base to Philippines or Vietnam or China or Bangladesh, or even Mexico, as a consequence of the cost of labor, and also quite often as a consequence of other regulatory laws and burdens and things of that nature. But the white collar, if you will, jobs remained in the West. And that's an interesting dynamic, because what I'm watching now is the very early stages of that changing. Let me give you an example. I was recently in Dubai. What are we now? We're in, I think it was May. I was over there. And in a building that I own some real estate in, which is very high value, extremely wealthy people that live there. So it's a great place to actually network. I was talking with a German industrialist. This gentleman runs a number of firms, pharmaceutical as well as media, in Germany and throughout Europe. In terms of his pharmaceutical businesses, over the last 15 years, he had already moved his industrial base, right? It's sitting in Eastern Europe already and in the Caucasus. Now he's sitting looking at the increasing taxation. He's looking at all of the other restrictions that are coming in from the green agenda. He's looking at all the other woke type of policies that are impacting businesses, whereby he can't even necessarily hire without diversity hires and all this other nonsense. And so guess what? Now his ability to shift what is human capital is actually much, much easier than what transpired before, which was shifting the industrial base. Like when you shift an industrial base, you've got to go and set up factories. You've got to it's capital intensive and it's difficult. But that transition already took place. It's happened. It's finished. It's over. It's done. And what remains is human capital. So he's now shifting his human capital. It's easy. He just calls the staff up. He says, we're moving. We're going to Dubai. And they're like, well, here's your offer. You can either move to Dubai with your family or find another job. And so he's shifting everything across to Dubai, across multiple firms. So, and he's not the only one. So that particular transition is already, in terms of the wealthy class, is already taking place. It brings on a number of risks and a number of opportunities. One, on the opportunity side, is identifying where that capital is going to move to. Two is identifying what's going to come as a consequence. And what's going to come as a consequence from the West, in particular, is higher taxation, is a clamping down, right? Because they're not going to change their policies. B, they don't want you to leave. So Australia, for example, has just implemented a tax thing where they will, if you leave the country, you're going to remain a tax resident for 3 years. You can't escape. Hotel California type of scenario. That's just a precursor of many, many more things to come. So the middle class will be trapped in increasingly burdensome jurisdictions with increasingly woke communist type policies, where their assets will be taken and where private property will become no more. To what extent, we will find out. There will be pushback some places, there's not pushback other places, etc. But that is certainly the trend. That's evident to anybody who opens their eyes, whether you like that or not. That is blatantly obvious. So it provides for, again, a convexity at a geographical and an international level that we've not had before. But we do have these sorts of transitions every 80 to 100 years. That's another historical cycle pattern. We're in that now. So you combine that with these other sectors which have convexity. And interestingly, a lot of them tie in with one another. Certainly on the energy front, there is a massive push to fight this particular element that is 0.04% of the atmosphere, with the idea that that is actually somehow the cause of all concerns. It's ludicrous to anyone with a brain, but it's gained a lot of traction, and it will continue to do so because propaganda works. So that is also coinciding with certain jurisdictions who are saying, no, we're not going to do that. Or they might have paid a little bit of lip service to it with respect to climate emissions and things of this nature, but on the ground, they're making absolutely no efforts to do so, and rightly so. Those jurisdictions are becoming net beneficiaries, and they will continue to be net beneficiaries of both the industrial base as well as subsequently the capital and human base that will move, because capital moves to where it's treated best. So we are in very interesting times, and ones where a lot of money, I think, is going to be lost. Far more is going to be lost than is made. But where it is made, there's a high convexity because there's not that many pools or places where the capital can go to. So it's like my friend Doug Casey once mentioned this with respect to, I think he was talking about gold mining stocks, and he said
the Hoover Dam.
It's trying to fit the contents of the Hoover Dam through a garden hose. To some extent, that's what's happening on an international basis. So, and again, within certain sectors.
Right. So you mentioned Australia being one example of where they might try to throttle capital flow outside of the country. Do you think that the collective West, or like all these jurisdictions that you're alluding to, do you think that they'll be successful from stopping capital to flowing from their jurisdictions to more favorable jurisdictions in the long run, or no?
Depends on what you're defining as successful. I believe they will be successful with respect to stopping many people moving their capital, because most people are cowards. If there's anything that the last 3 years taught us, it is that most people are absolute cowards. If you couldn't stand up to an 18-year-old pimple-faced teenager standing at the grocery store telling you to put a mask on, how the f are you going to stand up against this? And most people couldn't do it. It's insane, right? So yes, they will be successful in that. But what you got to understand is that it's not a static situation. Capital is not a static thing. If you cut off the flows of capital, it actually becomes worth less. So imagine, for example, a car. A car has value, right? Now take away the ability to put fuel in the car. What's the value of the car? Worth less. That's what happens to economies once you put in capital controls, once you put in these sorts of restrictions. The value that is produced by that economy collapses. We know this from historical precedents in communism, which has been implemented many, many times, or being attempted to be implemented many times in the past. So we're going through the same sort of situation. Now, the only question in my mind is the speed with which that takes place. I don't know. None of us do. But certainly you can see the evidence in front of your eyes, and you can see where the probabilities lie. One of the things that people can spend some time focusing on is simply debt levels. And debt levels, there's two components to it. One, the absolute debt levels relative to things like GDP, although that's not the best metric, but never mind, it's a decent enough one. The other one is the actual social structure of a society. In other words, take for example, a place like Thailand. In Thailand, there's not a political social structure in the same way that there is in a place like, say, Canada. In Canada, you are looked after by the state. Healthcare is determined by the state. Your education of your kids, bloody everything is tied to the state and the obligations that the state has to the citizens, but they haven't got the money to pay for it. So that's a different situation to a country where there isn't that level of liability to the state. They can have high debt levels, but it doesn't really matter if you're educating your kids. If there is the healthcare is down to you. If it's, I mean, a lot of these places, the family structure looks after the family. You know, you take the West, old people go into old age homes. In the East, they don't. The family look after them. And they don't expect the state to look after them.
And it's actually looked down if you don't do that too.
Oh, yeah. Yeah. You're not doing your duty to your clan, to your family. You're a bad person. So you've got a social structure. You've got a that is much more resilient to debt issues. And you've got a political situation whereby the obligations are just not the same. The state doesn't owe you anything, and you don't expect it of them. Pretty different. So these things are all impacting on what we just discussed, and I think they'll continue to do so, and at a increasingly convex type of situation, because as the as the as the sort of claws come down on the highly indebted, highly socialized countries, people will leave, right? And they will go to where? They're going to go to places that don't have those dynamics. And so there's actually a net beneficiary in the places that they simply don't have those liabilities. So whereby they might have liabilities, other liabilities, you could have countries with high debt to GDP levels, but if the actual liabilities to the citizenry don't exist, it's a different situation. And there will be capital flows into those places. The United Arab Emirates is a good example, very good example of exactly that situation. So, yeah, there's a lot to unpack, and I could talk about it for hours, but I'll stop there.
No, well, I mean, you're seeing it play out here in the United States, where you're seeing people flee from places like California, New York, into places like Florida, Georgia, Texas, the Southeast in general. So you're seeing it play out on, I guess, a national scale here in the United States. And there's a lot of money being pushed into somewhere like Miami, Florida. As you probably know, where I mean, you could easily see that as Wall Street, in 10, 20 years time, after enough capital moves away from New York. So you alluded to this 80 to 100 year cycle, in your description. How do these cycles work? What exactly are you referring to there?
Well, so look, there's many cycles that exist, and people will be very familiar with things like seasons. You have winter, you have summer, you have spring, you have autumn, and sure, sometimes they change. You can have a really warm winter, or you could have a really cold summer, but you still get the summer, you still get the winter, you still go through the cycles. You have the business cycle, which most people are fairly familiar with. Certainly, if you're in business, you would be, and it's sort of a 7 to 10 year time frame. And these things are consistent, right? Then you have a credit cycle that's roughly 30 years that we go through. The long-term debt cycle, which coincides with the war cycle, is where we're at now. So we have a culmination of cycles, which on a historical basis, they don't tell you exactly what's going to happen, but they simply tell you, it's like that spring's going to come, and you can look outside and the leaves haven't fallen off the trees yet. And normally, like this time last year, the leaves were off the trees. And you're like, yeah, it's a few weeks late. Maybe it's 3 weeks, maybe 4 weeks, right? But you understand the probability, and you understand that if you're going to place a bet, you're still going to place a bet that the trees are going to lose their leaves, right? And so in the same context, we are at that time frame with respect to war cycle, long-term debt cycle, currency regime change cycle. And so again, it allows for a certain predictability and probability, and it's prudent to understand what those cycles look like and to asset allocate accordingly. And I think this is a thing where, especially at this time frame, there's a danger for people to be very fixated on the short term. And I say that because if you take for the last 20 odd years, certainly in my career, people's investment timeframes have narrowed substantially. I was born in the 70s, but if you actually go back to the 60s, the average hold time for an equity is 14 years. The average hold time, I haven't checked today, but when I looked at this about 2-3 years ago, it was 3 months.
Yeah, it's a few months.
So, but you understand from a business perspective, like the fortunes of a business do not change over a 3-month time frame. Like not normally, right? Certainly not a substantial business. And so why would you be buying and selling over that time frame? And what it means is that people are momentum trading, and they're looking at this little element. Oh, the Fed's done this, and that means X, and I'm going to quickly trade. I'm going to sell, or I'm going to buy, and
more information flow too.
We are overloaded with information flow. And I think it's accelerated and exacerbated short-termism, while we have this huge long-term cycle that is bearing down on us. It's almost like a tsunami coming, and people are worried about the waves, right? And riding the waves. Do I catch that wave? It's a good surf wave, or, it's like, no, there's a tsunami. We know it's coming, right? Because there was an earthquake offshore, and predictably, after you have that, you maybe wait 6 hours or 2 hours, whatever it is. You don't really know, but you know there's a fucking tsunami coming, right? What are you surfing for? You're nuts. Get off the beach. So I kind of think it's a similar type of dynamic. And so for us, we don't focus on that short-termism. We watch it just like every other fund manager out there. We look at these things, but we try and understand it within the context of a grander picture, if you will, knowing that the probability is in our favor, and we need to be asset allocated according to that greater probability, while understanding that in the short term, we could have a whole lot of volatility. We could miss a really good wave to surf, right? But you can't kiss all the girls. So you don't want to be in a situation where you're trying to do both. And so that's essentially our strategy.
So you along this way, we alluded to as well, the capital's flowing, but then also the world reserve currency, that is the US dollar. Do you see that changing anytime soon? How long do these world reserve status, what's the longevity on these transitions?
There's been a number of different transitions, and some of them have taken multi-years, even decades, and others have happened more rapidly. You tend to have a more rapid change when you have a war, for obvious reasons. What I do know is that, to answer your question, and I'm not trying to skirt around it, we don't feel like we need to determine what the new currency might look like, or who it's issued by, or where that control mechanisms lie. Is it China that gets it? Is it whatever? We don't think that at this point in time, it's not necessary for us to make that judgment calculation. Because as you go through these currency regime changes, one thing almost always happens, and it is that underlying other values of other underlying assets rise against all currencies, which often then predicate the issuance of a new currency. So if you think about the transition from sterling to the US and that, you basically had Western Europe largely decimated from the war, and so your asset base was collapsed or devalued, if you will. And the United States didn't have the same issues. The United States' buildings were still intact. Its factories still operated, et cetera, et cetera. So if you think about that dynamic, what you needed to just understand was that you wanted to be owning the assets, right? If you now have a currency that is issued by that issuer, by the United States, that would become the predominant currency. But the trade wasn't really to buy dollars. The trade was just to buy the assets and the underlying country that wasn't decimated from the war. In the same light as today, when I look at fixed hard assets, things like energy, things like coal, things like uranium, things like oil, things like natural gas, things like copper, things like agriculture, fertilizer, there's a whole range of different things. Those particular assets are undervalued in any particular currency we want to choose. Ultimately, if there is a currency that becomes issued, for example, the BRICS, who've been talking about issuing a currency, and by the way, they're a long way off it, but let's just play the game as a thought experiment. They will back that currency with a basket of the goods that they produce. That just makes logical sense, aside from the fact that they've already stated that as a fact, that is what they intend to do. So do you then try and figure out what the BRICS currency is? Is it going to be mostly yen or euro, or no, it's not going to have any of those. Is it going to be yuan, rubles? Don't even bother. You just simply buy the assets that actually will become the underlying fundamental value for the fiat currency that is laid on top of it. So
Yeah, the de facto. I mean, it's the de facto
yeah,
currency in a sense. Yeah.
yeah. So like I don't know. I do know that on a historical time frame, we're going to go through a currency crisis. That's kind of evident because you can't pay back the debts that have been built up. And currency is simply short-dated debt, or debt is long-dated currency. Pick whichever way you want to view it. And that is completely, totally unsustainable, right? So how long does that take? I don't know, and I don't feel like I need to make that judgment call. We can see that it's unraveling. Look, you can see it's unraveling simply in terms of inflation numbers. So if people stop thinking about currency as a fiat currency thing, you take all the fiat currency world, then think about what other things could be currency: gold, silver, oil, uranium, farmland. Well, that's the currency you buy.
Right. So you touched upon inflation. Inflation is currently sitting at like 4 some odd percentage points. It's come down significantly from the 9 percentage points that we saw at the peak last year. Are we done with this cycle of inflation, or could it be something more along the lines of what we saw in the 80s, where we had multiple waves of inflation?
Yeah. So it's a great question. We've written about this, and you're probably familiar with it for some time. We don't believe that. Firstly, nothing happens in a linear fashion, right? So you can have inflation and you can have disinflation, but the inflation is always going to be higher than the cost of capital, and that's simply because they cannot afford to have the cost of capital arresting inflation. That doesn't help paying off large, substantial debts. And so, on a real basis, people are continuously going to have their wealth in terms of fiat currency inflated away. So you can have inflation running at 9%, then drops to 4%, but your ultimate cost of capital is going to be below that. Fed fund rates is always going to be below that. The other, of course, is that those numbers are garbage. They are rubbish. If you take your average person and they just tally up their bill of power, water, rent, education, goods from the grocery store, it's not running at 4%, right? It's just not. So,
yeah. But Chris, if you negate energy and food prices, then inflation is really not that bad. I mean, according to
yeah,
the Bureau of
we're
Labor
good.
Statistics.
Yeah,
Yeah.
just
If you don't need to eat, I mean, if you don't need to eat or drive a car or
hey,
heat or AC your house, then you're
fasting
good.
is extraordinarily good for you.
That is true. Yeah.
So I would counter that with saying starving's not particularly good for you. So it depends how long you want to go. But
Yeah.
no, like I mean, this is ridiculous. Yeah.
And isn't there also a point of where you raise interest rates, you're expecting to kill demand that way, but then don't you inadvertently bring up inflation through increased commodity prices, because these things are very you mentioned like oil rigs in one of your past interviews, like these things cost like $1 billion to build. These capital intensive industries that we trade in commodities, when the cost of capital goes up, so does the cost of producing this stuff to begin with. And when that cost goes up, the supply goes down, and you've got another wave of supply side commodity based inflation, don't you?
There is a continuous feedback loop, and you've just pointed out very well, both from the capital side of things, in that the cost of capital rises, which then makes companies reassess their forward-looking production. In other words, if you've got if you're going to go out and drill for oil, right? Or if we take the offshore space as it is today, they know where the oil is, right? It was drilled in the last cycle. It's just sitting on the shelf. They actually know what the flow rates are. They know what the cost of that oil is to get it out of the ground. That's known, which is a very unique situation, which is also why we're extraordinarily bullish on the offshore energy space. So that's one thing. The reason that it hasn't come in, of course, is that you've got political problems, i.e., you don't know if the government's going to turn around in a year's time and say, no, we're taxing offshore oil with a profits tax of 50% or some nonsense like that. So that's an element. The other major element, of course, is it's extraordinarily capital intensive, and it's a long time that you get for payback. Like you mentioned, it's a 1.2 roughly to put a rig in. OSVs to service it, you need 4 of those. They're about $65 to $70 million a pop. This is a very capital intensive operation to get your money back. And that could be $20 oil, but you've still got a lot of capital you've got to deploy before you're going to start recouping all that capital back. So you need to have a certain level of security in terms of that time frame. And that's increasingly become a political issue. So that dynamic's taking place, right? Which means you go, oh, we're just going to hold off. More decrease of supply. Now, the other thing, and because now we're talking about energy, means there's less energy around. You're going to move into another sector, making bread, for goodness sake. Well, now your cost of moving your flour and everything else to your bakery goes up, right? So your cost of your bread goes up. And if the cost of capital is going up, you might have a mortgage on your bakery. And that goes up. So now your cost of your bread goes up more. So you've got multiple dynamics all working at the same time, almost in a feedback loop, which are all pushing to less supply and higher costs of what are typically the critical goods. People aren't going to be particularly interested in a Netflix subscription or, a new fart app or whatever it is like that. So if we're looking at the critical goods and services that people require, those are going to continue to experience inflation. At the same time, we'll have, could call it deflation in certain other sectors. I like to call it stagflation. We're going to have a stagflationary environment, because in a stagflationary environment, what you have is low productivity, right? Which is what we're seeing, lower productivity, and high rates and high cost of goods. The previous experiences that people have had with respect to inflation have been demand-led growth. Oh, the BRICS are opening up. Oh, China's got billions of people. Oh, there's Thailand, there's Indonesia, right. And they're all wanting air conditioners and da-da-da-da-da. So you had this higher demand for goods, which was pushing up the underlying prices of commodities and everything else that goes with it. That's not this trade. That's not this trade. This is not demand-led. This is supply crush, literally.
Yeah, which is kind of like the antithesis of all of these Keynesian-based economists, like Yellen. She's purely labor, so she doesn't really understand what's going on in terms of the supply side. She only sees demand side. So we've had a lot of talk about a recession on the horizon. What do you see in the next year or two? Do you see a recession? We've covered on the channel here. We're still seeing housing pretty strong in terms of housing starts still a little bit below their average. Checkable deposits are still up, as well as delinquencies are still down as well compared to where they were. They're significantly down where they were in 2008, for example. So, is this kind of a case where all of this talk about a recession is kind of creating a self-fulfilling prophecy where people just keep cash on the sideline and as a result just bring down the money velocity, just bring down spending and cause a recession that way? I know that was a bit long-winded, but
yeah. Well, firstly, I'll point out, of course, that you're speaking almost specifically with respect to the United States, and we cover the globe. So just so people understand what we're talking about here, because there's a lot of different things taking place in different parts of the world, which we are invested into and watching. With respect to the United States, one of the benefits, if you will, that you folks have over there is long-term credit markets. In other words, you can go and get a mortgage for 30 years. I'm not sure exactly the numbers. My buddy Jason Hartman had them the other day, and it was something like 60 or 70% of all the mortgages. I think it was even higher. I have to look up the numbers, but it was a significant portion of the mortgages aren't going to roll for at least 10 years. And so your higher costs of capital don't have any impact on those mortgages or those people's. And it's funny because you go back about 4 years, I vividly remember Brad and I sitting having conversations with Glenn Hawking clients, and they're like, oh, well, I've got this property here and there, and what do you think I do? Do you think I sell it and maybe buy some of your stuff, or what do I? And our like absolute statement at that time was like, no, the trade here is to just keep the debt. In fact, go and borrow against it, because it's not about the real estate. It's about the debt. If you can get, and you could get like 3% for 30 years. I'm like, that's a gift, because inflation is going to run much higher than 3%. If you can lock that in for 30 years, that's golden. Like, get as much as you can, provided you've got sufficient cash flows, of course, to meet any of the contingencies that can crop up. And so that continues to be the case, because I think inflation is going to keep punching higher, and the cost of capital with respect to mortgages is still sub what it should be, at least in terms of real rates. So I think that from the housing start side of things and all of that, there is a certain level of insulation that exists in the United States economy that does not exist in other parts of the world. If we're thinking about real estate, Canada's in a much more precarious situation. Australia, New Zealand are in horrible positions, because your debt markets, your credit markets are just, they're functionally very different. So, but with respect to, and even like with recession, you're talking about recession, it's a little bit like inflation. The way that they're determining recessions now, it's like you can self-identify as anything these days, right? A recession can self-identify as not being a recession anymore, and inflation can self-identify as not needing to have energy or education in it. And
no longer 2 consecutive quarters of GDP decline. So
there you go, exactly my point. So to some extent, in order to when you change the definitions of language, then we can't understand what we're talking about. What we tend to do to try and mitigate getting into that whole debate is just look at the numbers and just look at where things are going, in particular with respect to the sectors that we're invested into. So I almost don't even like getting into the debate of, are we going to have a recession? Is it a recession? Are we in one? Are we out one? I'm like, I don't care. I just need to know what's happening with where my capital is invested. Is it in that inflationary bracket because I need it to be, or is it not? So because they're going to continue to screw around and make you believe things that are unbelievable. So I don't even want to get into that debate. It's like debating some person that's decided that they're a bi-trans pod plant, or I'm not even having the conversation. It's pointless. It's not worth my time.
Yeah.
So in the same light, with respect to these numbers that they keep manipulating and changing the definitions of, I can sit there and argue and point out how they've actually just lied. But you kind of just, it's like yelling at your dog.
There's no communication anymore. I mean, the very fundamental basis of communication is that we have agreed upon definitions to articulate. So,
yeah. So I think it's useful to just not engage. It's like you sit there and you acknowledge that the person's lying to you. You can tell them that they're lying to you, and you just leave it there. You don't debate it. You don't debate a dog. Why would you debate a dog? All that he hears is whoa, whoa, whoa. It's like dog talk to you, woof, woof, woof. We don't know what they're saying, right? It's just there's the communication breakdown is too severe. So it's not. I like to do things that are actually going to benefit my time, and that doesn't benefit my time. So I just try not to engage in it.
Yeah. So what about China? So China reopened this year, but it was kind of muted. We didn't see any big, commodity demand spike from, by way of China. What happened with China?
So, well, one of the things that we know from the previous decade is that China's been stockpiling massively. Not only are they stockpiling domestically in terms of actual physical stockpiles, but they have been stockpiling with respect to putting together contracts throughout the rest of the world, in particular in Africa. So they have secured vast resources, and they continue to do so. I have a friend that works at CEO of one of the largest banks in Africa, whereby they're conducting and putting together most of these particular deals. China is on average getting 80 to 90% off takes with 30-year deals. And you can't throw a dart at a bloody map of Africa and not hit Chinese financing. So they they've been stockpiling domestically, internationally. They've been securing continuously many of these assets, and so as they opened, I don't think they're feeling the same need to actually go and secure and buy resources. They could actually quite easily sell down or use up some of their inventory, because they've and certainly through COVID, same thing. They've secured massive amounts during this time frame, and coincidentally, ironically, this entire ESG anti-fossil fuels charade has massively benefited them. So they've taken advantage of the fact that their competition is not playing the game anymore. I mean, if you go into the metals in that space, you've got Trafigura, Glencore. That's kind of it, and then everything's Chinese. And the Europeans don't even exist. I mean, a little bit they're trying to come in now into this. I'm just talking about Africa. The US have basically given up on it. They figure that they don't need it, and to some extent you could argue that's true, because the United States has significant resources of their own, but not in certain elements, certainly not in things like rare earths. But no, it's you know, and that comes back to the topic that we talked about at the beginning, which is this transition, this 80, 90-year history. And what you can always watch before is the capital flows. You know, when you see wars break out, people will often be like, oh, that's surprising. And they always think it's for reasons that aren't necessarily kind of the true predictors. You can predict the stuff by watching the capital flows beforehand. Imagine if you and I were going to go to war. What do? Like, we know, like, we're going to go.
I'm going to dump your debt. Any debt that I have.
You're going to dump my debt if you hold any. You're going to start stockpiling the particular things that you need in case I invade, and I'm going to do the same thing. Why are Eastern central banks the biggest purchasers of gold in history?
Yeah. Why?
So,
and it's been that way over the last. They've been stockpiling more and more gold over the last 10 years or so.
It's now. I mean, I've got a chart literally just sitting on my desktop in front of me. It's going parabolic. So you can see that the capital movements towards what is most likely, it doesn't mean it's going to happen, but it's just, all investing is probability. That's what it is. You're going to run probabilities, and then you're going to price the probabilities, and you want to be trying to buy things that have got the highest probability and convexity for you. That's it. And if you can do that across multiple asset classes more, then you reduce your risk. So that's essentially what we do. So yeah.
Yeah. So a current market outlook. So we've got oil at $70. The S&P's been going up. So what's going on here? Why are we getting kind of signals of deflation going on? Despite like OPEC cutting, continuing to cut production over and over again, but yet the oil price keeps going down and down.
I think oil is setting up to be one of the biggest convex trades that is going to exist going forward. We're at some of the lowest levels of inventory. We have, to answer your question, I think there's a lot of it is based on recessionary fears, and it's based on demand crush of the demand's not going to be, we're going to have a recession, Europe's in a recession. We're not going to have the same level of demand. And then you also had a dynamic whereby, remember last year, the best performing sector largely was one of them was energy. At least outside of oil.
Yeah.
So oil didn't actually go anywhere. But if you look at a lot of the equities, they were some of the best performing space. So your asset managers have been selling down and taking profits on a number of those as well. And the entire sort of zeitgeist, if you will, with respect to energy has changed. But if we look at the fundamentals, they're still very, very favorable. I'm reminded of the quote from George Soros, which was that, what did he say? He said, find the premise that is false and bet against it. And I believe that the premise that there's sufficient energy, I believe that to be false. So I don't know how much lower it goes, but I do know that that is one of the highest convexity trades. I do know that energy is absolutely required for humanity. And I do know that we're moving very rapidly into a much more fractious geopolitical environment with war. And I've never, ever seen a deflationary war.
Fair enough. Well, I've got you on the energy trade, uranium sitting at $58, something in that ballpark. What's going on with uranium?
Yeah. So I think it's uranium is firstly, it's an extraordinarily volatile market. The other component behind it is that it's price inelastic. It's price inelastic insofar as the utilities, if you've got a nuclear power plant, they are price insensitive. The cost for their uranium is very, very fractional with respect to their overall operating expenditure. And so they don't really care about the price. They do care about supply, right? They have to have the supply, otherwise the operation doesn't work, right? It's a little bit like, water. You might look around, you go, oh, I need food and I need all this, but like you're going to die without water. And you might think it's in terms of cost, like if you're going to the supermarket, water is going to be a very small cost with respect to your overall shopping if you're buying water. But without it, you're dead. It's a little bit like that. And so it tends to be extraordinarily volatile, and it also gets done on long-term contracts. So you go through quite a lot of volatility. We've been through the first phase. We had the run-up, come back down, and it's going to run again. So I'm bullish on uranium. I'm bullish on most of the energy sector. There is insufficient supply. The other component, and we could talk all day about this on uranium, but the other component that you've got to be aware of is that it's not necessarily, it's true that uranium supply is an issue, but that entire supply chain is an issue insofar as you need to have enriched uranium to actually use it in a nuclear power plant. And guess who owns all the enrichment? Kazatomprom, which is basically Russian controlled. And guess who the West trying to attack and kill? Russia. So you've got this very interesting dynamic whereby I look at that, I'm like, I do not want to be short that. That's for sure. Like I wouldn't, you'd have to put a gun loaded at my head for me to short that, right? So if I'm not going to be short that, then having at least some position weighting long makes a lot of sense, especially when you've got the fundamentals of supply and demand in your favor. So bearing in mind that it is going to be volatile because it is a very, very volatile type of pricing of an asset.
Got it. I know we have about a couple minutes left, but really quick, nat gas, what are you seeing with nat gas? Have we based out yet or?
Yeah, it's not a market that I know. Look, I'm a generalist. So broadly we're bullish on it. We're basically bullish as a consequence of a couple of things. Shale in particular, where the offtake on shale was very, very bearish, if you will, for the price of natty gas, right? Because you just had so much excess natural gas. That entire dynamics changed. We don't have the same level of shale. We think there's going to be Permian's the only one that's not in decline. And so the other component behind natty gas, of course, is that largely it's a domestically driven market within the United States. Sure, they're shipping up to Europe because they fucking blew up their pipeline with Russia, so I'm less bullish on the natty side of things. We have positioning in it, partly also as a hedge, domestic hedge within the United States, and certainly the prices have come down quite substantially. So it's a positioning that I'm happy to have on a small weighting.
Understood. Gotcha. Well, I think that wraps it up for today's episode, guys. If you enjoyed this content, be sure to give us a like, a subscribe, leave a comment down below if you agree or disagree with any of our comments in this episode. Chris, do you have anything that you want to leave the audience with before we sign off?
Nope. Other than be brave, be strong, think for yourself, and don't be complacent.
Awesome. Well, with that said, guys, I will see you in the next episode. Bye, y'all.